how about if we explain the security market line? Well, this is nothing but a picture of the capital asset pricing model. All right, so here's a great question is what's the difference between CML and SML? And here's the big difference. The big difference is look on that horizontal axis. Back with the capital market line, we had total risk. We had standard deviation on that axis. Here we have beta. So William Sharpe is assuming that all investors are holding diversified portfolios and beta is the only thing that matters. Notice the security market line starts at the risk-free rate. It is upward sloping to the right. Of course, investors will only take on more risk. They'll only assume more beta if they're offered more compensation. All right, and so note that slope is going to be, well, just like the slope was back in the capital market line, it's going to be the market risk premium in this case. There's the formula for the capital asset pricing model and the security market line. And notice that what we've done is we've put that formula for beta in there so that you get a better sense of what that beta means. Now, in general, betas are going to be between 0 and 2. In general, they don't have to be. When I wrote my dissertation, I calculated the beta for, what did I tell you guys, over 2,000 stocks. A handful of them were negative, and some of them were over 2. And in fact, I had a couple that were even over 3. But I did it for about a 2-year period, and so all that means is that the covariance between that individual stock and the market portfolio was really high or negative during that time period. But in general, it's okay to think of betas as being between 0 and 2. All right, so make sure that you know the big differences between CML and the SML. Let me go ahead and show you guys the picture of the security market line and how it relates to overvaluation and undervaluation. Now, think of the security market line as the equilibrium point of supply and demand for all stocks. Remember all those assumptions that William Sharpe gave us a few slides ago. If all of those assumptions hold true, then every stock will fall directly on that security market line. They are fairly valued. Now, if some of those assumptions don't really work, like, oh, let's take, for example, we do pay taxes, or there is some restrictions on short selling, and maybe some others of those that you don't like, they might cause an individual stock to fall outside of the security market line. And that's what I have there with the green and the red. So let's start with the red. And let me go ahead and ask you guys a question. If you want to buy that security that is the red star, well, clearly that red star is under the security market line and it has a given level of beta, right? But you can move just directly up on the security market line and get a greater expected return. So you would never want any securities that fall under the security market line. Those are overvalued. In fact, you might want to short those. On the other hand, look at the green. Do you want these green securities? Of course, you would love to have this green security, right? So if you knew that green security was up there, what would you do? You would run to the New York Stock Exchange and buy that stock. And what would happen to its price? Its price would gradually bid up. You'd bid that price up. And what would happen to the expected return? It would fall until it's right directly on the security market line. All right, so remember this. Securities that are located under the SML are overvalued. Securities that are located over the SML are undervalued. Now, of course, capital asset pricing model is not perfect. It has some limitations. William Sharpe relied on this notion of the true market portfolio, which contains all securities and financial assets and non-financial assets that are out there. Sometime after the capital asset pricing model was introduced, there was a guy named Richard Roll who came out with his Roll's critique. And one of those was that using the S&P 500 index as the market portfolio excluded all assets that are out there that are not included in the S&P 500 index, like, some small cap stocks, or maybe some emerging market stocks, or some bonds, or maybe gold, or movie memorabilia. And so lots of these things are not investable, but we have a great conversation in store for alternative assets. There we go. Of course, different analysts might use different proxies for the market portfolio. And then beta Remember I told you that I computed beta over a 2-year period, and some were negative and some were higher than 2. But if I had picked a different 2-year period, maybe they would have all been positive. Maybe they would have all been around 1. Who knows? And so the selection of the time period will greatly influence what the level of systematic risk is. And then, of course, you guys know this, there are no two people that think alike, let alone requiring all investors to have homogeneous expectations. Now, what that means is there might be many optimal risky portfolios and multiple security market lines. And that's the basis for our future discussions on active portfolio management. Hey, that was part 2. I think that was fun. We'll do some portfolio planning and construction. That's going to be a good one too.